How does banking deregulation relate to subprime lending? Have you ever wondered how the rules around banking can affect the loans people get? Let's break down the connection between banking deregulation and subprime lending. Banking deregulation means reducing or removing government rules that control how financial institutions operate. This shift started in the United States in the 1970s and picked up speed with changes in the late 1990s and early 2000s. With deregulation, banks were allowed to do more things. They could create and sell complex financial products like mortgage-backed securities and collateralized debt obligations. These products often included subprime mortgages, which are loans given to people with lower credit scores or a higher chance of not being able to pay back the loan. So, how do these two concepts connect? First, deregulation removed the barriers that used to keep different types of banking separate. This meant that banks could more easily offer subprime loans to borrowers. They were looking to make higher profits by taking on more risk. Next, the way banks handled loans changed. Instead of keeping loans on their books, they began to sell them quickly to other companies. This meant that mortgage originators, who might not even be regulated banks, could issue subprime loans and sell them to special-purpose vehicles. These vehicles would then bundle the loans into mortgage-backed securities to sell to investors worldwide. Another point is that, with fewer regulations, banks loosened their lending standards. This made it easier for subprime borrowers to get loans, often without checking if they could actually pay them back. The demand for high-yield securities backed by these loans pushed banks to lend more to riskier borrowers. Additionally, banking deregulation led to the rise of shadow banking. This refers to financial institutions that operate outside traditional banking regulations. They often financed mortgage securities with short-term loans. This system was risky because it could face sudden credit withdrawals, leading to liquidity problems when confidence in the market dropped. From a liberal viewpoint, this situation shows a failure to keep enough government oversight to protect consumers and the economy. Critics argue that deregulation focused too much on market freedom and profit, neglecting financial stability and fair access to credit. This lack of regulation contributed to risky lending practices, which played a big role in the subprime mortgage crisis and the financial collapse that followed. This experience highlights the need for balanced regulations that ensure transparency and responsible lending. It is essential to monitor financial innovations to prevent excessive risk-taking that can hurt vulnerable borrowers and destabilize the economy. The liberal perspective advocates for rules that protect consumers and keep the financial system stable, rather than relying solely on market forces.